Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today, we're going to talk about how to view your home within your financial life and your financial plan. So for most people, your home is the single biggest purchase you'll ever make and is one of your most valuable assets. But despite it being so important, not everyone knows how to look at it within the context of their overall financial situation. So what we'll do today is start by explaining a little bit about how your home works as an investment and source of wealth and how it grows over time. We'll then discuss how to think about converting that value into something you can use if you want to. And we'll wrap up by talking about how to look at your home as part of your overall financial and retirement plan, and some of the different roles it can play and why each might be attractive to you. And Andrew, just to check, do you consider your home to be your most valuable asset, or is it still your first Michigan football jersey?
I shouldn't even have to pause to answer this. So I'll say it's our home.
All right. I wasn't sure, but glad to see where the line's drawn. So why don't you kick things off by explaining how to think about your home as an investment?
Sure. So starting at the most basic level, when you buy a house, you typically pay a certain amount of the purchase price in cash up front, which is referred to as a down payment, and then borrow money in the form of a mortgage to cover the remaining amount. For example, you might buy a house that costs $500, put $100,000 of your own money toward this purchase as a down payment, and then borrow the remaining $400,000 by taking out a mortgage. And we'll use $100,000 as a down payment in this example, but you do have flexibility in terms of how much of your own money you want to use up front for that down payment. Or some people even decide to make the entire purchase in cash, but for the vast majority of people, you'll borrow some portion of the purchase price through that mortgage. So on day one, after you purchase a home, you have a $500,000 house, which consists of $100,000 you paid in cash and $400,000 you borrowed. And continuing with an extremely basic example, if you turned around on day two and sold the house for $500,000, you'd get your $100,000 back in the mortgage we paid off without factoring in real estate commissions or any other costs. Or said differently, you'd be in the exact same spot from a financial perspective, at least on paper, but instead of having $100,000 of your money tied up in the house, you have $100,000 of your money in cash. And this idea of having quote-unquote money in your house is referred to as equity, which is simply taking your home value and subtracting the mortgage. We'll walk through an example of how this changes, but the first step is to understand what your home equity is referring to. And this concept of home equity is essentially the exact same as looking at your net worth, which, as we've explained in prior episodes, is your assets minus your liabilities or debt. In other words, it's the difference between what you own and what you owe. And the reason your net worth is important can be highlighted using two polar opposite scenarios. In one scenario, you could have $10 million of assets and $9.9 million of debt, which means you have a $100,000 net worth. In another scenario, you could have $200,000 of assets and no debt, which means you have a $200,000 net worth. Obviously, this is an extreme contrast, but it highlights how someone with $200,000 of assets may be better off than someone with $10 million of assets. And this comes up more often with real estate and home equity because of how large of an expense a home can be, and because it's one of the few assets that allows you to borrow that high of a dollar amount against it. So isolating just your home equity, but following the same logic as comparing your net worth, it's worth reminding yourself that a $1 million house with an $800,000 mortgage still results in less home equity than having a $250,000 house with zero mortgage. This is why it's so important to not just focus on what you own, but also what you owe. And with the higher level definition of what equity is and why it's important, the next part we'll touch on is how this changes over time. So Trent, why don't you walk us through some of those changes?
Yeah, so while most people don't explicitly think of their home as an investment when they buy it, it can actually be considered an investment in the sense that it's an asset whose value increases over time. And going back to what Andrew just explained about your home's equity being the important thing to focus on, I'll now explain the two ways your equity can grow. The first and most straightforward way it grows is simply by paying back your mortgage. Each month, you're paying a certain amount of money toward your mortgage, and a portion of that money goes toward paying back the principal of your mortgage, or in other words, reducing the size of your mortgage. And not to get too far into the weeds, but the way mortgage payments are calculated, during the early years of paying back your mortgage, a larger portion of each dollar you pay goes toward paying interest, and a smaller portion goes toward paying principal, while during the later years of paying back your mortgage, this equation flips, and a smaller portion of each dollar goes toward paying interest, while a larger portion goes toward paying principal. Just to get some context and quantification, if you took out a 30-year mortgage at a 3% interest rate today, during the first year, for each dollar you paid toward the mortgage, 60 cents would go toward interest and 40 cents would go toward principal. Whereas in year 20 of paying it back, for each dollar you paid, 27 cents would go toward interest, while 73 cents would go toward principal. So knowing that each year of paying your mortgage, you're reducing the size of it, as long as the value of your home is either stable or increasing, the value of your home equity, the difference between the value of your home and the size of your mortgage, is increasing. So paying back your mortgage is the more straightforward and mechanical way that the value of your home equity grows over time. The second way it can grow is through the price of your home increasing. As mentioned, unlike cars, which are depreciating assets where their value declines over time, homes are appreciating assets whose value increases over time.
Except for today, where cars and used cars are somehow appreciating.
Yeah, this is such a bizarre period where people are actually getting paid to turn their cars back in after their lease is up.
I know, it's so hard to believe.
Yeah, maybe that'll be another podcast episode in itself. But going back to how your home equity grows over time through price appreciation, if you look at the average annual increase in U.S. home prices going back to the Great Depression era, it's been around 4% per year on average. As a side note, just for comparison, the average annual return for the U.S. stock market, as proxied by the S&P 500, over the same period has been around 11%. So looking at homes compared to some of the other investment options that are available, they haven't historically looked great on a relative basis, but have still provided a positive return and one that's outpaced inflation, which has historically averaged around 3% per year. Now, one thing worth noting is that while on average home prices have increased by around 4% annually, there's often a significant difference in what home price appreciation different people have actually realized for a variety of reasons. One of the biggest ones is geography, since real estate tends to be very local, so depending on the city or area you live in, you could see much different price appreciation. For example, some cities like San Francisco or Denver have been very hot over the past several years and have seen their home prices rise dramatically, while others, like Chicago, haven't seen nearly the same amount of price appreciation. And even within these cities, different neighborhoods experience different dynamics, so it truly is a local dynamic depending on the specific location. So unlike someone who's investing in the S&P 500, where they'll earn the exact same return whether they live in San Francisco or Chicago, for someone buying a house, that won't be the case, and the actual return each person realizes will be different. The other aspect to consider with home price appreciation is timing, where the return you realize depends on when you bought the investment. Although this is true for any investment, so it isn't necessarily unique to real estate. So while U.S. home prices have historically risen by around 4% per year on average, it hasn't been a consistent 4% every year, and there are ups and downs in terms of price fluctuations, similar to the stock market, although the swings are much less dramatic. For example, the past couple years have been an abnormally strong period for the U.S. housing market, and average home prices increased by double digits during both 2020 and 2021. However, looking a bit further back in history, you'd see that home prices on average declined each year for the 4 years from 2007 to 2011 as the economy struggled during the Great Financial Crisis. But net, home prices do tend to rise over time, and assuming you own your home for a reasonably long time, you'd expect its price to increase. So bringing it back to our discussion of home equity, which we explained is the most important aspect to focus on when thinking about your home as a financial asset, the value of your home equity will increase over time as you, 1, pay down your mortgage, and 2, the price of your home increases. Now, it's great to know that you have this financial asset in the form of your home equity that's increasing over time, but it's another thing to understand how you can actually capitalize on it. So, Andrew, why don't you talk a little bit about the options there and how to view it within your overall financial plan?
Yeah, well, like Trent just mentioned, having equity that increases over time looks great on paper, but it's different than being able to readily tap into it or to capitalize on that equity. So there are several ways that you can capitalize or take advantage of your home equity. And starting with the most obvious one, you can sell your home. And if you have $500,000 of equity in your home, you could sell your home, pay off the remaining amount of your mortgage, if any, and be left with $500,000 of cash minus the real estate commission. So that's one way to tap into $500,000 of your equity and become homeless overnight, which we know most people prefer to have a place to live, relative to $500,000. But the reality is most people that are selling their home to tap into the equity aren't planning to be homeless and are either downsizing homes, renting, or needing to be in a long-term care facility like a nursing home. Another way you could tap into your home equity is by doing a cash-out refinance, which is essentially taking cash out from your equity, as the name implies, in exchange for a larger mortgage. So looking at an example where you have $1 million home with a $500,000 mortgage, you have $500,000 of equity. And let's say you want to tap into $300,000. Well, one route is a cash-out refinance, where you borrow or cash out $300,000 in exchange for a larger mortgage, which would be $800,000 in our example. Your mortgage size would increase from $500,000 to $800,000, but you would then have $300,000 of cash that you could do what you wanted with, whether that's investing it, using it for renovations, starting a business, etc. Now, your overall net worth wouldn't change as a result of this, but you would essentially be trading some of your home's equity for cash. It's worth noting that there are fees associated with doing a cash-out refinance, and lenders have requirements for how much of the home equity you're even able to take out in the first place. But this illustrates the point that it's another way to access the equity in your home. A third way, which is less common and more relevant to people later in life, is something called a reverse mortgage, which it's important to note that there are potential risks and costs involved here that makes this route less appealing. But in basic terms, the way a reverse mortgage works is that assuming you're age 62 and have sufficient equity in your home, rather than you making mortgage payments to the lender, things flip around and the lender starts making payments to you. Because the lender is now paying you, the size of your mortgage gradually increases and your home equity declines. And when you eventually move or pass away, the home is sold and the proceeds are used to pay off the outstanding mortgage balance. As you can see, a reverse mortgage is essentially a way to turn your home equity into a stream of cash flow if you need to and don't have any other assets available. So those are a few of the main ways you can access your home equity, which tends to become a sizable asset over time, especially later in life when approaching retirement. But as I mentioned earlier, you'll always need a place to live, so not everyone knows how to incorporate your home equity into an overall financial plan. And how you incorporate your home into your financial plan will be unique to you, but it typically follows a more common trend based on your stage of life. If you're younger and your current house isn't your forever house, a good way to think about your home equity is to earmark it as money that you'll be able to use or roll forward to put toward the down payment for your quote-unquote forever house. For example, let's say you live in a $400,000 house and have $100,000 of equity, but eventually you want to buy your dream house for $1 million and put 20% down, or $200,000. Well, you can know that you already have half of that $200,000 down payment in equity in your current home, and therefore you only need to save up for the other half, while also knowing your existing home equity will likely continue to grow between now and the time when you eventually sell it. If, on the other hand, you're already living in your forever home, another way to think about your home equity is money that can be tapped, if needed, for renovations or other large home projects. As I mentioned, a cash-out mortgage refinance is a way to convert your equity into cash, and depending on interest rates, it can be a way to lower your interest rate and finance larger expenses, such as the cost of renovations, at the same time. We're not always proponents of increasing debt if you can avoid it, but there are situations where it can be the best option based on what's most important to you. And the last phase, which we'll elaborate a little more on, is how to view your home equity heading into retirement as a part of your overall retirement plan. So Trent, why don't you walk through this final phase and why we approach it a little different than the other stages?
Yeah, so as a starting point, we typically take a more conservative approach heading into or in retirement and plan on not needing to access the money in your home equity in order to fund your retirement. The biggest reason we approach it this way is because we always prefer to have a little extra cushion or margin of safety in retirement plans. And the rationale may seem pretty obvious, but it's essentially that when thinking about two potential risks in retirement of, on one hand, running out of money, and on the other hand, ending up with more than planned at the end of life and leaving more to heirs than you intended, the vast majority of people would prefer the latter. So when we put together retirement plans for clients and run retirement projections, we don't include the value of home equity in those projections. You'll always need a place to live, and not everyone wants to downsize or move to a different home during retirement. So we don't want to assume that home equity will be available to use in retirement, even if we know that it can be tapped if needed. So we prefer to exclude the value of home equity in our projections, and we know that by doing this, the equity will still be there and can serve different roles and provide different options in the plan. So what are some of these? Well, one is just providing additional financial cushion to protect against the key risks of a retirement plan. The biggest one being sequence of returns risk. When you retire and stop collecting a paycheck from your employer, you take your retirement investments and savings and use them to recreate that monthly or biweekly paycheck by withdrawing from your accounts. A key part of the planning process is making sure the amount you plan to withdraw each year, your withdrawal rate, is considered safe relative to the size of your investments. However, depending on what that withdrawal rate is, you can still run into a situation where immediately after you retire and begin withdrawing from your investments, the stock market experiences a large temporary decline or bear market, and the value of your investments declines and the amount of money you're withdrawing from them relative to the value of your investments, your withdrawal rate rises. If this happens and you know you have additional money available in the form of your home equity that can be accessed if needed, it gives you an additional backstop and provides more wiggle room and runway to ride things out until the market recovers. Another role that home equity can serve in a retirement plan is an inheritance. While there's no right or wrong approach when it comes to this area, some people have a desire to leave a certain amount of money to heirs, and home equity can be a nice way to accomplish this while also adding cushion to your retirement plan, because you know the money would be available for you to access if truly needed, but as a baseline, it's not being earmarked for any specific use in retirement, and in all likelihood, when you eventually pass away, your heirs will be able to inherit the house, which most likely won't have a mortgage at that point, and either keep it or sell it. Homes are also a very tax-efficient way to give money to heirs because when you pass away, your heirs receive what's called a step-up in basis for your home, where the cost of the home, for tax purposes, is adjusted upward to its market value when you die. Because of this, if your heirs turn around and immediately sell the home, they won't owe taxes on it since they'll be selling the home for the same amount as their cost as defined by the IRS, and therefore there won't be any gains to pay taxes on. This can be pretty significant, especially if you own the home for a long time. For example, if you bought a home for $200,000 30 years ago and it's now worth $800,000, that would be $600,000 of gains that wouldn't be taxable for your heirs. A third role your home and home equity can play in retirement is serving as your long-term care plan. The data show that there's a good chance most people will experience some type of long-term care stay late in life, and there's a big range in terms of the potential cost. Based on the data from the U.S. Department of Health and Human Services, approximately 7 out of 10 retirees will spend less than $50,000 on long-term care per person. Approximately 2 out of 10 will spend between $50,000 and $250,000 per person. And approximately 1 out of 10 will end up spending more than $250,000 per person. So it's a potentially large and uncertain cost, but at the same time, while there's insurance available to guard against the risk, the insurance tends to be expensive, and it's often a catch-22 where if you can afford it, you probably don't need it since you can self-insure, whereas if you need it, you probably can't afford it. So from this perspective, home equity can act as part of your long-term care plan because the money isn't earmarked for anything else, and you know that if you do experience a costly long-term care stay, the money can be accessed and used to pay for your care, whether that's through selling the home and the healthier spouse downsizing to a smaller home, using a reverse mortgage, or some other strategy. And if you don't experience a long-term care stay, that's just additional money for your heirs. So that's just a quick overview of how we view home equity within a retirement plan and why we prefer to err on the side of being conservative and keeping more options and flexibility. Well, that covers everything we wanted to with today's discussion, and I know we threw out a lot of numbers and math with some of the examples, but hopefully we were able to explain it in a straightforward way. Homes are such an important and common part of people's financial lives, but despite that, there's not always as much understanding of how to view them as financial assets and within the context of your financial life and plan, so hopefully we were able to provide that. To give a recap of some of the key points, number 1, when thinking about your home as a financial asset, the most important thing to focus on is the value of your home equity, which is the difference between the value of your home and the amount of money left on your mortgage. In other words, equity is similar to net worth in that it's the difference between what you own and what you owe, and is therefore the money that's truly yours and is available to you. Number 2, the value of your home equity, or the value of your home as a financial asset, grows over time due to 2 factors. One is that as you pay down your mortgage, you owe less money, and that difference between what you own and owe increases. And the second is that home prices increase over time, although the rate depends on geography. Because of these dynamics, the value of your home equity grows over time, and for most people, it becomes a significant financial asset, especially as you approach retirement. Number 3, the equity in your home is money that can be accessed if you'd like. And there are different ways to do this, including selling the home, doing a cash-out mortgage refinance to convert your equity into cash by increasing the size of your mortgage, and less common strategies such as a reverse mortgage if you're over age 62. And lastly, number 4, when it comes to retirement planning, we prefer to plan on not using home equity to fund your retirement. The reason we like this conservative approach is because it provides more margin of safety with retirement projections, while at the same time providing flexibility and options in other parts of the retirement plan, such as leaving a legacy to heirs or having a cushion to protect against long-term care risks. Well, thank you everyone for joining us for another episode of the show. As always, you can find the show notes at the podcast page of our website at mdwmllc.com/podcast. And if you have thoughts to share or questions you'd like to have answered, please feel free to shoot us an email at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.